Hi, my name is Susie Rhodes, and I will be your teacher. Thank you so much for choosing Test Teachers as your online pre-licensed education provider. We have been teaching people just like you to pass your pre-licensing exam on your first attempt for over 35 years. Let's get started. Section 1, Life Insurance, Types of Policies. I grew up in this industry, but I really never thought much about life insurance until I graduated from college and got married right away. We moved away from our hometown to a new place, got pregnant. My husband got a job where he had to drive very far to go to work. And my friends told me that the road that he was driving down to go to work every day was called Pray For Me 93. So we had moved from Arizona, where it's warm, to Boulder, Colorado, where it snows all the time. And here was my husband driving down Pray For Me 93 to go to work every day. And I thought, I need life insurance. What if something happened? Here I'd be alone with a baby. So we went out and we bought our first life insurance policy. So life insurance isn't something that you think about when you're young and healthy, which is actually when you should buy it, because you're underwritten on your age, your health, at the time you buy the policy. So we went ahead and got it, but it's generally not until you're older when you realize how important life insurance is. So there's lots of different types of life insurance policies that a person can purchase. So it's important that we understand the different characteristics of each of these types of policies. We're going to start off with what is called whole life. Whole life is sometimes called traditional life insurance. It's the very first life insurance product that was invented. You'll sometimes see it referred to as ordinary whole life. Whole life is a type of permanent protection. So that's something that they will love on your test. Whole life insures you for your whole life. It's permanent. It lasts forever until you die, or statistically speaking, we should all be gone from this world by age 100. So whole life is a type of permanent policy that provides protection from the time in which you purchase it until you die or until you reach age 100. So let me show you a little bit about how it works. The most important key to whole life is that it's protection that lasts till age 100. Let's say you're 30 years old and you decide that you want to purchase some life insurance. So the underwriter at the insurance company is going to most usually ask you to pass a physical exam. So you're going to be underwritten based upon your gender, your age, your health, your hobbies, which the test will call your avocation, versus your vocation, which is also an underwriting factor. Your vocation is your job. So they're going to put you through underwriting, and they're going to determine a premium based upon what is called your original age, the age you are when you purchase the policy. So whole life, permanent, lasts until you are what age? Age 100. Whole life has a fixed premium. So the premium, like I had said earlier, is based upon these items at this point. So for example, let's say when I bought my life insurance at age 30, I didn't smoke, but when I was 40, I started smoking. Don't do that. But let's say that happened. They can't change my premiums. My premiums are fixed. They're based upon the things that were true when I purchased the policy. So this is my premium. It will not change. Let's say I buy a face amount. So this is the death benefit of $100,000. So whole life, purchased at age 30, fixed premium, $100,000 face amount. Now, you can purchase different face amounts. This is just the example that we're going to use for the class. $1,000 is my premium. That premium is never going to change. It's going to always be $1,000. So I have this permanent protection. And one of the things that's very nice about whole life is they're going to take my premium and they're going to put it into what is called the insurance company's general account. and they're going to pay me a guaranteed interest rate. So this is a policy that has cash value. Whole life is a cash value type of policy. So in the general account, the insurance company promises to pay a guaranteed interest rate. So the interest rate is guaranteed never to be below. So it's a minimum guaranteed interest rate, whatever it says in the policy. So let's say that it says that they promise to pay me 4%. It could be 2 or 3, but we'll just use an example of 4%. So they promise to pay me 4% on my premiums that they put into this general account. So if the general account for the insurance company should earn 12%, what do they promise to pay me? 4%. But what if they only earn 1%? What do I get paid? I still get the 4%. So it has a guaranteed cash value. So I pay the premium to start off. We're going to pay the premium on an annual basis. How often you pay your premium is called mode of payment. So we're going to assume for the test that the premium is paid annually, unless the test question says otherwise. So it's true that you can pay it more frequently than annually. Let's say you wanted to pay it monthly. You can do that. Is it more or less expensive the more frequently you pay it? What is it? It's going to be more expensive because they're going to charge you service fees. So this is the default, this is the assumption for the test that you're paying an annual premium. So if I pay in my annual premium and then I die 6 months later, $100,000 goes to my beneficiary tax-free. Life insurance policy proceeds are tax-free to the beneficiary. So if I don't die in the beginning, I pay this annual premium every single year. And there's this growing cash value. And if I live to be 100, this is an important truism for all whole life policies. Cash value is equal to the policy's face amount at age 100. So if I live to be 100, which I'm telling you, I'm going to live to be like 105 probably. I live to be 100, they're going to send me a check for $100,000. If I die at age 99, $100,000 goes tax-free to the beneficiary. So in this general account, we have this growing interest. So attached to the policy, when you purchase the policy, will be a table of cash value. This idea that this whole life policy has growing cash value. So when you buy the policy, you can look into this table and you can see, as a general rule, the cash value is 0 for the first 3 years. There's no ability to take out a loan. That's what's so great about cash value. Anytime you need to, you can take money out of this policy. The insurance company is, of course, going to charge you interest on your loan. You don't have to pay off your loan. If you die without paying off your loan, what's paid? Face amount minus the loan plus interest. So can you take out a loan in the first 3 years? No. So you purchase a policy at age 30, there's no cash value for the first 3 years. Does that mean you don't have protection? No, you have protection. You have protection. That's what life insurance is. It's protection. If you die right away, face amount goes to your beneficiary. You just can't take out a loan until you do have a positive cash value. Then over time, exactly what the cash value is going to be at each of these specific ages, we know. Because of the fact that the cash value is in what account of the insurance company? It's in the general account. And when we have the money in the general account, the test wants you to remember who has the risk. The insurance company, the insurer, has the risk because they promise to pay this minimum guaranteed interest rate. So if they don't earn 4%, they promise to pay you 4%. If they earn more than that, that's where they make their money. The insurance companies really have this figured out. So at each specific age on this table of cash value, I can see exactly what my cash value is going to be at each specific age. So I'm looking at my table of cash value, and I notice that by the time I am 65, it says that my cash value is guaranteed to be, let's say, $40,000. What is cash value made up of? It's made up of two things. It's made up of the premiums plus this interest. So we said no cash value in the first 3 years because there's cost associated with this policy. Someone sold it to me, so they make a good commission, just like you're going to be doing. There's costs built into the beginning years of the policy, so no cash value in the first 3 years. But after that, exactly what the cash value is going to be, we know because as far as the premium payments go on ordinary or straight whole life, they're fixed. They never change. You pay the same amount every year for the life of the policy. So you pay the premium every year until you die or until you reach age 100. So by the time I'm 65, how many thousands of dollars have I paid into this policy? 35,000, age 30 to age 65. What's the other 5,000? That's the earnings. That's the earnings. If I die at age 65, how much does this policy pay? We said that the face amount of the policy is $100,000. So if I die at age 65, the insurance company has promised to pay $100,000. How much of that is the insurance company's risk? Well, remember on this table of cash value, it grows over time. So that by the time I am 65, my cash value is guaranteed to be, we said, $40,000. So that if I died at age 65, how much does the insurance company have to come up with out of their own money to get to the $100,000? $60,000. So it's this idea that over time, if I was to die at age 30, not very likely, right? Insurance companies taking on a lot of risk. If I was to die at age 30, they have a lot of risk. They would have to come up with the whole $100,000 face amount. But if I die at age 65, here's my cash value. So that the face amount includes the cash value. So it's this idea that if I take out a loan, which I can do for whatever reason at any time, and I don't pay back the loan, there's interest that's going to accrue on the loan, they're going to keep some of that cash value and use it to pay back the loan. So that the face amount is comprised of some risk for the insurance company and my growing cash value. So that if I die at age 65, you can look at this one of two ways. The insurance company pays $100,000 and they kept my $40,000 cash value. Or you can look at it like they pay me my $40,000 cash value and they come up with out of their own pocket $60,000. It's the same thing. It's $100,000 either way. So in one scenario, we say that they keep it, pay $100,000. In the other scenario, we say they pay it. It doesn't matter. Some students like to look at it one way, and other students, it makes more sense to them the other way. So when I buy life insurance, does the insurance company expect me to die in the beginning? No, the insurance company is betting that I'm going to live. I'm betting that I'm going to die. So that's why you buy it, this protection. Over time, the insurance company's risk is offset by the insured's, that's the client, growing cash value. So that by the time I'm 99, if I was to die then, the insurance company's risk is very minimal. If I live to be 100, cash value equals face amount, and they send me a check. So we need to understand what would happen if that were the case. So if I was to die at age 99, $100,000 would go to the beneficiary tax-free. But what if I lived to my 100th birthday? The insurance company is going to send me a check, say, congratulations, thanks for not dying. They earned 12% on my money and paid me 4%, so they're happy. And this check is going to be comprised of two things. So when I bought this policy at age 30, and I lived to be 100, in my example, there was an annual premium of $1,000. So I lived to be 100 and they send me a check. How many thousands of dollars have I paid into this policy? Got it at age 30, now I'm 100. I've paid in $70,000. This is what's called my cost basis. So when you pay your premium for your life insurance, you're paying the premium with after-tax dollars. So that if you live to be 100, they send you your face amount minus your cost basis. You can't owe taxes on your own after-tax dollars. So I don't owe taxes on that. But this 30, this represents my interest. This is taxable as ordinary income. So if you live to 100, they pay out your policy. Whatever that interest earned is, that amount is taxable as ordinary income. Remind me, if I had died at age 77, my beneficiary gets $100,000, taxable or tax-free? Tax-free. Life insurance policy proceeds are always tax-free to the beneficiary. Traditional whole life. What makes it this term straight whole life is the fact that the premium is being paid in every year until you die or until you reach age 100. So if you ever see the term straight whole life, it's talking about the premium payments. So that's a good place to start. Insurance companies have found that people tend to lapse out of their whole life policies when they reach retirement. So here I am now, I have 4 kids, and when I reach retirement, my kids will all be grown, they'll all be off on their own, and I don't know if protection is going to be as important as it once was to me. So insurance companies have found that people tend to lapse out of their policies when they reach retirement age. They're looking at ways to control their budgets. They decide that, heck, if I die tomorrow, my kids will be sad, but they've all grown up. They have their own jobs, their own lives. I'm not really responsible for providing that protection for them anymore. So one of the things that insurance companies came up with to help avoid this problem from happening is another type of whole life where the premium payments are crunched down into the beginning. What they're called is limited pay policies. So limited pay policies, you have to be really careful on this test. They like to use the term limited pay, and they want you to understand it is still whole life. So if a limited pay policy is still whole life, it provides permanent protection until what age? Age 100. So the difference with a limited pay policy is that we're going to shorten the premium pay-in period. So for example, LP 65. So life paid up at age 65. It could be LP 90 or LP 52 or whatever the client wants. It's just LP 65 is very common. So life paid up at age 65. So if I bought this policy at age 30, I pay my premiums until what age? LP 65, I pay my premiums until I am age 65. It provides protection until when? Age 100. Cash value equals face amount at age 100. So that's true for all whole life policies. Test question could be, what is the premium payments with an LP 65? Are they going to be more or less than the premiums that you had to pay on an ordinary whole life policy? Well, if you think about it, in this example, we have half as long to pay in the premiums. So the premiums must be, simplistically speaking, twice as much. So we're going to just double the premiums. If I'm paying in twice as much every year, what do you think about the cash value at age 65, more or less? It's more. So another concept for the exam, when you have a limited pay policy, the cash value grows more quickly in the beginning years because you're paying in the premiums in the beginning years and you're paying in a higher premium than you did with ordinary life insurance. So the cash value, we'll just double it, $70,000. You don't ever have to pay a premium again. You have permanent protection until you reach age 100. LP 65. So a potential test question, something like this. Comparing an LP 65 policy with an ordinary whole life policy, both purchased at age 30. If you were to die at age 40, which one was a better deal? Okay, so they're not going to say it quite like that, but it's this idea, it's this concept. If you have an ordinary straight whole life policy, you pay in the premiums every year for the life of the policy, versus an LP 65, which one have you had to pay in less for the same amount of protection? ordinary whole life would be the answer. When you have a limited pay policy, you're crunching down those premium payments, so you're paying more in the beginning. So the ordinary whole life was a better deal for you, meaning that it cost you less for the same amount of protection. Granted, you have to pay it all the way through to age 100 on an ordinary whole life policy. So something like that. The questions are very conceptual, where you have to apply your knowledge, which you'll do just fine. But remember, when you're doing this, generally speaking, you don't have any background in this industry. So it's kind of like learning a foreign language when you first start off. The further along you go in the course, the more you practice the exams, the easier this will be. So give yourself credit. You can do it. It takes a little bit of practice. So LP 65, life paid up at age 65. Cash value grows more quickly in the beginning. Another way they might classify a limited pay policy is going to look something like this: 30 pay life. One insurance company came up with LP 65, and then another insurance company thought, ooh, well, that's a good idea, but we're going to call it something different. It's the same thing. It's just expressed slightly differently. So it's like a Band-Aid and an adhesive strip. I still stick them on my kids. Doesn't matter what they're called. So if you buy a 30 pay life, a test question might want you to understand you pay the premiums if you buy a 30 pay life at age 30. You pay the premiums until what age? 60. Cash value equals face amount on a 30 pay life at what age? 100. So 30 pay life is a type of whole life policy, both limited pay policies. So which of these two would be more expensive? Purchased at age 30, the 30 pay life would be. You can do this. There's another one of these limited pay policies that they might ask you about, and that's what's called a one pay life or a single premium policy. This idea that instead of paying your premiums over the lifespan, or maybe over 35 years like we did in that example, at age 30 you just give them all of the money all at once. Now, in the real world, you're going to get a discount. It's not going to cost you the same amount, but we're just going to be simplistic here. You pay the $70,000 in the beginning, you never pay again. Cash value equals face amount at age 100. So you have protection. If you die in the beginning, it's $100,000. If you die anywhere along the 70 years, the face amount's $100,000. But the test wants you to understand that a one-pay life is the only type of whole life policy that has immediate cash value. You better have the ability to take out a loan right away in the beginning if you're paying in all of the premiums up front. So a one pay life, a single premium policy, you can take out a loan right away in the beginning. You could do that. There's another type of whole life policy that you will be asked questions about, and that is called adjustable whole life. The test likes this policy, adjustable whole life. So if it's a whole life policy, it provides protection until what age? Oh, yes, age 100. And what it allows a client to do, it allows them to adjust the premiums, the face amount, and the term of protection, which is always a test question. What can you change? So you can pay in more, you can pay in less. The face amount can go up and down, but never above what you were originally underwritten for. So if you bought a $100,000 adjustable whole life policy, you can't just, make it a $250,000 policy because you feel like it. But you can pay in less and then pay in more, enough to get yourself back up to the original face amount that you were underwritten for. So when you pay in more, when you pay in less, does the face amount change? Yes. Can how long the protection lasts for change? Yes. It is a policy that we classify under the category of whole life, which is age 100. But it's actually got two components to it. It's got term and it has whole life. So this policy is best for a client that has fluctuating incomes. So someone maybe in real estate would be good for this policy, adjustable whole life. Someone who isn't quite sure what it is that they're going to be earning next year. So as their income goes up and down, anyone with a fluctuating income, anyone in an obviously commission-based profession would be good. This is just a common example for the test. So adjustable whole life has some term and some whole life, which is interesting because we don't even know what term insurance is yet. So just a little bit of an introduction for term insurance. Term insurance is temporary. Term insurance is good for a period of time. Term insurance is pure protection, where whole life has cash value. Term insurance has no cash value. So part of your premium goes towards term coverage and part of it goes towards whole life. So the whole life is the permanent protection. So you pay in more, you pay in less. The face amount can go up and go down. The length of coverage can get longer or shorter depending upon how a person's income level has been. So it's a good policy for someone with a fluctuating income. The way that they write some questions sometimes, in my humble opinion from doing this for so many years, I think that what they do is they take the outline for the test and they look at it and they try to write a question based upon how things are categorized on the outline. So there's a question that they love on the test and it goes like this. Is adjustable whole life an interest-sensitive product? The answer is always no. It's not under that heading on the outline, if that makes sense. So the book is written to follow the outline published by the testing company. And adjustable whole life is a combination product, some term, some whole life. But it's not an interest-sensitive product. The interest-sensitive products are coming up next. So the test really likes you to remember adjustable whole life, not an interest-sensitive product. It's kind of a strange emphasis on the exam. What are these interest-sensitive products? We start off with universal whole life. Universal life is a policy that was created in the early 80s, back when interest rates were really high. Universal life is the first type of interest-sensitive whole life product. It's tied to interest rates. So in the early 80s, interest rates were really high, and this was a very popular product. Today, interest rates, not very high, not a very popular product, but you just never know what the future is going to hold. Always on the test, for sure. You need to understand universal life is tied to interest rates. It has a flexible premium. So traditional whole life, limited pay, ordinary whole life, we had a fixed premium. With adjustable whole life, we had an adjustable premium. With universal life, we have a flexible premium. So the test likes these distinguishing characteristics. So what does this flexible premium mean? How does this work? So flexible premium tied to interest rates. When we have universal life, a portion of the coverage is comprised of term insurance. And the other portion of coverage is this cash value. This cash value has a current interest rate. So in the early 80s, the current interest rate was 18%. It also has a minimum guaranteed interest rate, the one that we've been using all along, 4%. This idea that some of your premium that you pay in, let's say you have this target premium, $1,000. Part of your premium goes in to buy you term insurance. As a general rule, term is 10 times less expensive than whole life. So you pay in your premium, part of it goes to buy term insurance. The rest of your premium goes into this cash value account. And this cash value account earns a current rate. It's guaranteed to earn this for 1 year. And then every year they make an adjustment to the current rate to be reflective of the current interest rates in the market, promising never to go below whatever the minimum guaranteed interest rate is. So this is in the general account of the insurance company. The insurance company has the risk because they're making a promise to the insured.